I already talked a lot about this at the beginning of the class when we talked about partnership tax returns and S-corp tax returns. Essentially, they're like information returns. So they have to report their income and expenses, but they don't actually pay income tax as part of that tax return. Now, there are other types of taxes that partnerships and S-corps will pay. If they've got employees, then they're going to be paying half of the Social Security and Medicare taxes for those employees. If they own property, they're going to be paying property taxes. If they sell goods, they're going to be paying sales taxes if they're in a jurisdiction that has sales taxes. If they're importing certain items, they may be paying excise taxes. So there are lots of other taxes that these types of companies will pay, but they don't pay federal income taxes themselves. But they still have to report all of that income and the expenses. But the income and expense then flows through or passes through to the owners of that entity. Partnerships are, the best way to describe partnerships is they're like a sole proprietorship in that they have a lot of the same rules as far as self-employment income goes. Partners in partnerships, if they're active in the business, they have to pay self-employment tax on that income. So they're like a sole proprietorship, but it's more than one person. Remember, sole proprietorship can only be one person. So even if a husband and a wife own a company together, what would otherwise be a sole proprietorship, because it's more than one person, they're a partnership, and they have to file a partnership tax return. S corporations, so I'm going to talk a minute about C corporations. C corporations are probably the corporations that most of you are familiar with. They're the corporations where they can have an unlimited number of shareholders. Maybe their shares are traded publicly, or might be publicly, might be privately. We usually think of them as bigger companies, but they don't have to be big companies. They can be small, but in our minds, that's kind of what we think of with C corporations. It means that you can go out and buy stock in these companies, and there's really no restriction on who can buy that stock. You can be, whether you're an American citizen or resident or not, it doesn't matter. You can still buy stock. It's in that company and become an owner. So there are a lot fewer restrictions with regard to stock ownership for C corporations. C corporations do pay tax on their net earnings. So they have a separate tax return as well, but they do pay income tax themselves. Some of them have been really good at being able to avoid paying income tax over the years, but they are subject to income tax. Now, an S corporation is kind of a hybrid between a partnership and a C corporation. It's still a corporation, it still has shareholders, but in a lot of ways it's like a partnership. Instead, it's not the stock of S corporations isn't publicly traded. Not just anybody can buy the stock. There are limitations on who can purchase the stock. There are limitations on the number of shareholders that can be owners in the S corporation. And the owners of the S corporation, just like partners in a partnership, share in the earnings and profits of that S corporation. So for our purposes, what we're talking about here are those flow-through entities where the earnings and the profits, although they're reported on the net earnings, even though they're reported on a separate tax return, the actual tax is being paid by the owners of that company, okay? That is reported then on that page 2 of the Schedule E. Remember that very first section of the Schedule E. And the thing about all of the income and expenses is, as we know already, because we've gone through a lot of this, different income is taxed in different ways, right? Capital gains are taxed differently from wages. There are different rules for it. we've got that whole netting issue with capital gains, whether it's long-term, whether it's short-term. Qualified dividends are another example of income that's taxed differently from other types of income, even ordinary dividends. It has a different special treatment. Rental income is taxed differently. There are limitations on how much of a loss you can take on rental income. There's a passive income loss limitations, which, like I said, that's chapter 13. We don't go into them, but there are restrictions and limits on how much you can take for a loss. Different deductions as well are treated differently. The charitable contributions. Companies can make charitable contributions. The owners of those companies, may or may not be itemizing their deductions. So any charitable contribution that is made by the company flows through, by the partnership or the S Corp, flows through then to the owner. The owner may or may not be able to take advantage of that deduction. But all of these items are treated differently under the tax code. And so as a result of that, we have to know the specifics of each type of income from the partnership or the S Corp. These are called separately stated items, and they are exactly that. On the form that partnerships and shareholders receive, all of these items are listed separately from the first line on it, and I'll show you a picture of it. It's called a Form K1. First line on it is ordinary income. So that would be income from all of their ordinary operations. If it's a partner and they're active in that business, that ordinary income would be subject to self-employment tax, because essentially it's just like sole proprietorship income, right? And if it were sole proprietorship, it would be subject to self-employment tax. Next up is interest income. That's listed separately on that form as well. And then dividends, qualified dividends, ordinary dividends, and then all the different categories of capital gains. You'll recognize some of these boxes as we go through them. A lot of them are from the last chapter that we just went through, but they're separately stated because they retain their character when they go through and get reported to, it's so small, when they get reported to the shareholder. Maybe that. Okay, so this is what a K1 looks like, and I think we took a quick peek at one of these on Tuesday, did we not? Anybody remember? Okay, so you can see up here, it says little K1. This one is for a partnership because it says right at the top, it's a 1065. All of the information on the left is information about the partnership and about the partner. So we've got W&S Woodworking is the partnership. Jose Ramirez is the partner. Jose is a general partner, which means he is active in the partnership. So ordinary income to him would be subject to self-employment tax. He is a domestic partner. If he were not active, if he was just a passive investor, he would be considered a limited partner, in which case this ordinary income would not be subject to self-employment tax because he's not providing any efforts toward earning that money. Down here is his ownership percentage. So he owns 40% of the partnership, which means that all of the income and expense items and all of the credits and different deductions, he gets to declare 40% of them from the partnership. Now, the 40% calculation has already been made on this form. So, don't worry about this stuff, the capital account analysis and the liabilities. That's more business tax level class. These over here on the right are all the separately stated items. Line 1, ordinary business income. This is the amount of, so W&S Woodworking obviously got some income, they did some work. This is his portion of the net taxable ordinary income from that tax return. But there's other items too. So there would be, if they had any rental income, it would be listed in one of these boxes. I'll talk about guaranteed payments when we get to chapter 14. placed directly on the Form 1040, as though he received a 1099 with these qualified and ordinary dividends. Let's see, royalties, if he had received any if the partnership had received any royalties, his portion of those royalties would be listed in box 7. Short-term and long-term capital gains. These are treated just as though they were received, he had sold that stock himself. And this is his share of the gain or loss of those items. Now, if you look, I'm gonna pull up Schedule D here. So if you look at the Schedule D, you'll see, where's it here? Net short-term gain or loss from partnerships, S corporations, estates and trusts, those are the flow-through entities, from Schedules K1. Okay, so line 5 addresses this specifically. We would put for his short-term capital gain $133. $133 would go on line 5. That loss for long-term capital gains, the $400, we're gonna put that down here. Net long-term gain or loss from partnerships, estates, other flow-through entities. We're gonna put that there. It gets netted with all of the other capital gains and losses. It becomes part of that whole calculation that we did in chapter 7. You'll see collectibles. It's hard to see because it's blurry, but this says 28% gain or loss. And those collectibles, if they sold collectibles, they're gonna be taxed at 28% gain. That would then go onto the second page over here. It would be part of that gain, 28% gain worksheet. Unrecaptured section 1250 gain, right there. Net section 1231 gain or loss. Other types of income or loss. Section 179 deduction, that is stated separately as well because section 179, remember we've got those limits on a per taxpayer basis, or per tax return basis. So if he has another business where he's got section 179, that's going to be combined then with this section 179 deduction, and it's going, if the total of the two exceed the limits, then he's going to have to, he's gonna still be restricted to whatever that limit is. Okay, so that's gonna be combined there. That goes on, let's see, we have Schedule E, yeah. So this would be W and S woodworking. It is a partnership, so we're gonna call it a P, it's not foreign. Taxpayer ID number, I don't know, 4, 5, 6, 7, 8, 9. None of these. Passive loss, it's not a passive activity, so it has no passive income or loss. Non-passive loss, we don't have a loss. We do have section 179 expense though, and we do have non-passive income of 2130. All of that's gonna get combined, so H and K there, G, I, and J, 3600, combined lines 30 and 31, and have an overall loss, because we get to claim that, that section 179 deduction. Now, what that does essentially is it eliminates any of the self-employment tax. That section 179 deduction eliminates the self-employment tax. Then we get down into other types of deductions. There are codes. If you were to look at the back of a K1, let me see if I can pull up K1 form. Well, there are codes on the back, so K1 codes. There we go. Of course, it's really tiny. View it. Okay, so there's all these codes for the different lines. So for example, other deductions, we've got other deductions here, and it's a code G. So you look at line 12, other deductions, contributions, 100% contributions. Those are charitable contributions. So Mr. Ramirez has a $2,000 charitable contribution deduction that can then transfer over to his Schedule A, but guess what? If he doesn't itemize, he doesn't get to use it, right? It's only gonna benefit him if he actually itemizes his deductions. So the different types of deductions, they may or may not be able to use. So we got a category for non-cash contributions. Let's see what other. So those don't really apply anymore. Different types of credits as well, that the company may be eligible for that then flow through to the owner, to the owners would be listed as well, and all of those things go in different places on the tax return. This chart up here, we can make it smaller so we can see it. This chart shows where everything would go. So that ordinary income, that's what we listed on Schedule E, right? Showed you that, the 2130. Dividends go directly on the Form 1040, on the very front of that form. Like I said, as though he received a 1099 for them. Short-term capital gain or loss onto the Schedule D. Net long-term gain or loss, same place. Charitable contributions go directly onto Schedule A. 179 expense is going to be listed both on the Schedule E and on the 4562. It's going to be included in any other 179 that's on that 4562. And then if there were any earnings from self-employment, which in his case there isn't because the section 179 absorbs all of the income. If he didn't have that section 179, then that 2130 would be subject to self-employment tax, and he would file, he would fill out and include that income on the Schedule SE in that calculation. Okay. They do talk a little bit about guaranteed payments. So that is line 4 or A, B, or C. So guaranteed payments act sort of like a salary for partners. Remember, partners are not employees. If you are a partner in a partnership, you cannot be an employee of that partnership. You can be an employee of a partnership as long as you're not a partner, if you're working for the partnership, right? And there are a lot of them that do. They have employees, but if you're an owner, if you're a partner, you are not an employee. But oftentimes partners will still receive a salary. If they're providing services to the partnership, then they get some sort of, sometimes not, some sort of remuneration. If that salary is not dependent on income from the partnership, and by that I mean it can't say your salary is 10% of the net income that we received. It has to be some sort, it could be an hourly rate, it could be a salary, but it can't be dependent upon the income from the partnership. If the partner receives something like that, then that's called a guaranteed payment. It acts like a salary, but there's no withholding from it. So that Social Security and Medicare tax has to be paid by the partner. It's again considered to be self-employment income. Okay, so that's what what am I trying to say? That's what that guaranteed payment is. The guaranteed payment is also deductible to the partnership. So in essence, it also reduces the partner's share of ordinary income because it's a salary that they're, receiving, but then they have to turn around and declare that guaranteed payment as income. Okay, what else do I wanna say about this? There's something else I was gonna mention here. So this shows how this was recorded, which is what we did on our Schedule E there as well. Ultimately, it comes down here, it gets combined with any other pass-through entities. Something else I wanted to say. Okay, so S corporations, like I said, they're kind of this hybrid between partnerships and C corporations. They also, they're called shareholders, though they're not partners in an S corporation. Shareholders in an S corporation also receive a K-1. Shareholders in an S corporation, though, can be employees of the S corporation. So that's one way in which they're like C corporations. Their wages are treated, a little different in how they report them, but they can be employees of S corporations. That K-1 looks very similar for the S corporation as it does for the partnership. I already talked about passive activity. Passive activity, if you don't materially participate, it's treated like an investment. Okay? So if it's treated like an investment as well, it would be subject to that net investment income tax if your income is over those limits. And we talked about that tax, I think in chapter 6. Here's a little bit about those passive loss rules. Taxpayers can deduct passive losses to the extent that there is passive income, so up to 0. Any excess cannot be used to offset active or portfolio income, but can be carried forward. But in cases of rental activity, taxpayer is allowed up to a $25,000 rental loss against other non-passive income. There are phase-outs, though. There are AGI phase-outs for that. So once you get to a certain income level, that $25,000 starts to go away. And it's only for rental. That's it. What questions do you have?
So on these shoe boxes, there's some of them that start with like a